Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Our guest today is a full-time real estate investor who started buying multifamily properties in 2013 and now controls over $460 million of real estate with a portfolio just shy of 5,500 units. Before that, he was the youngest vice president at an award-winning New York advertising agency. He is the host of the Best Real Estate Investing Ever podcast, which is the world's longest running daily real estate investing podcast, where he has interviewed guests like Robert Kiyosaki and Barbara Corcoran. Plus, he is also the author of 3 real estate investing and syndication books, and his real estate advice has been featured on Forbes, Yahoo Finance, Huffington Post, and he has been named the 2018 Multifamily Investor of the Year by Think Realty. Joe Fairless is the managing partner at Ashcroft Capital. Joe, welcome to Purchase to Profits. It's great to have you on the show.
Yeah, looking forward to our conversation, Seth.
Yes, so am I. So to get things started, do you want to tell us what your real estate goals are?
Well, I mean, the number one goal is to perform on our existing portfolio. I think there tends to be a sexy goal of acquiring a certain amount of real estate and continuing to grow. But I think that misses the mark for where the focus really should be, and that is organic growth. Because the beauty of what we do is real estate is very friendly to those who adhere to certain fundamentals in their deals. And I call them the 3 immutable laws of real estate investing. One is buy cash flowing properties. 2 is have debt on the properties that's at least two times as long as your business plan, and 3 is adequate cash reserves. So I know as long as we continue to work on our portfolio and deliver on expectations and exceed as much as we can on those expectations, then any type of quantifiable goal that we have in our business will be achieved as a result of that. And in fact, I have a vision board on my wall. I'm looking at it right now, and there's a phrase on it, and it says, "What can I do today to be better than yesterday?" And so if there is any more tactical goal of mine, it is to make sure that I'm improving every single day, not only myself, but also the business. I remember when I interviewed Robert Kiyosaki and on my podcast, and we were talking about how he determines which deals he participates in and he does not. He said, well, I always ask the potential partner, what's the last couple books that you read? And if they don't immediately name some books that they read, then he says, well, why would I invest with you if you don't invest in yourself?
That's a very deep and good answer. I like that. So do you have any, we were talking while you were mentioning that you just want to keep growing, and do you have any routines or rituals that you do maybe daily or weekly or monthly that really keeps things top of mind?
Yeah, absolutely. Well, I have a vision board I do every January. It doesn't have to be every January, that's just what I do every January. And it's a 3 feet by 5 feet a vision board. So it's huge. It's a big poster. I got to get it custom printed on from a local printer to put on my wall. So I've got that. I take that poster and I take that vision board. I also put it on my phone. I also put it on my desktop of my computer. So I'm constantly surrounded by it. I'm constantly surrounded by the vision that I have. So that's 1. 2 is I do a daily journal. I've been doing a daily journal for about 3.5, almost 4 years now. And all it is, it's simply a Word document. And in that Word document, it's the day's date and then bullet points of whatever I want to talk about. I've made it a slightly more structured. And now what I have, I'll pull it up right now because I just updated it this year where I have a 4 things that I fill in every day. And so before it was free flowing, now it's a little bit more structured. 1 is I'm feeling, and then colon. So I put in whatever I'm feeling at the moment. I learned, colon. I'm grateful for, colon. And then what did I do today to be better tomorrow? Question mark. And those are some prompts obviously, that help me keep the right stuff and the important stuff in mind. So that's a second routine that I do. A third, and I've been doing this for about 5 years, I drink a liter of water with a scoop of wheatgrass. Learned about alkalizing my body through Tony Robbins, and what he talks about. And so I think those are the three things that come to mind. Exercise is very important to me too. I just bought a walking desk so that the majority of the day when I'm on calls, I can be walking in my office instead of sitting on my butt.
Yep. The standing desk and the walking desk, lots of guys really swear by them.
Mm-hmm. Yep.
So one thing I think that's unique about your answer with your goals is you've really taken a holistic view of your life. So they're not really real estate centric goals. So do you mind just explaining how just taking that broader view of your whole life has impacted your real estate?
Yeah, and it definitely ties in. It's a good point. It is more holistic, but the important thing for me to know is how I make money and how the revenue from my different activities ties into my overarching goals and thought process. So with improving every day, how that helps the business and how ultimately that helps my financial situation as well as those around me and my investors is when I'm improving every day, when I'm finding things to get better at on a regular basis, well, that translates into better profit margins for investors, and that translates into achieving the results, the projections that we have on our deal. So here's a specific example. When I when I do my podcast, I interview real estate professionals, and I've interviewed like 1,600 real estate investors, and in fact, I think I've interviewed more real estate investors than anyone else in the world. I think I have to double check that, but I just had that epiphany a couple days ago. But when I interview these investors, I learn a whole lot. It's a beautiful thing. I'm learning all the time, and those lessons are then applied towards our portfolio. So, for example, when I was interviewing someone who was talking about artificial intelligence and incorporating that into apartment units, I thought that's something we need to do more of. We were already doing it some, but this gentleman had some unique angles that he was using, and it was his company. So then my business partner and I talked to him afterwards, and we're incorporating some of his stuff into our apartments. And that definitely has a direct correlation to delivering on a property level higher results. And then as a result of that, more investors are talking about our deals, which helps organic growth, which goes back to our focus on making sure that we meet or exceed expectations on our portfolio. So I'd say the interview-based thought leadership platform that I have, which you have as well, is incredibly helpful to not only personally develop, so it helps me be better than I was yesterday, but also there's a direct correlation, since I'm interviewing real estate experts, to the bottom line for my business.
Yeah. And your podcast has been a big part of your business growth. Are there any things that you thought would really work out for you, but turned out to not be so good?
Yeah, a couple things. One, let's see. Well, I wanted to. I realized that having a large email list that is engaged, which I have been focused on growing, and I have a 20% open rate and 3 or 4% click through rate, which is pretty good industry.
That's really good. Yeah.
I wanted to double, triple, quadruple that, and I wanted to do it in a shorter period of time. And I was like, well, what are some ways to do that? One of the ideas I had was to buy a list of people and from one of these list companies, and just send them an email, see if they want to opt in, and then add them to the list. They've got thousands and thousands of people, tens of thousands of people. So it's like, okay, great. So I invested about $2,500 into this exercise, and I forget how many they sent out. I want to say around 25,000 people, something like that. I got literally zero new people in my database. Literally zero. Not figurative, literally zero. I think there was one click, and that one person decided, no, not for me, buddy. Thanks, so.
Yeah.
That was a complete flop. And so the lesson I learned there is there are ways to expedite our path, but not all the ways work. And you just I gotta try some out. Some work, some don't. Were you gonna ask something?
No, keep going.
And then the other is I had a house. It was the fourth house. So I've bought 4 homes, and I switched to apartment communities. My fourth house I bought for $35,000 with a $40,000 line of credit. And so I had $5,000 remaining on the line of credit from American Airlines Credit Union at 7 or 8%. I forget what percent. And I was going to put the remaining $5,000 of the line of credit. So bought it for 35, had 5 left. I was going to put the remaining 5 into the renovation. So all in, I'd be 40,000, which happened to be the line of credit that I was approved for. Bought the house for 35 as planned. Renovations did not go as planned. I was living in New York City. The house was in Fort Worth, Texas, and is in Fort Worth, Texas. It still exists, even though I don't own it. And the renovations went way over budget. Once the house was fully renovated, it leased for about the same as it was leasing for prior to the renovations. I ended up, going over budget like $10,000, $15,000, which it's a lot of money now, but at the time it was a significant amount of money to me, based on me owning three homes, and that was my 4th. I mean, that was a really big deal. What I learned from that is, one, my construction crew that did the renovations, it was a friend of mine's dad, and it didn't work out. So what I learned from it is don't involve friends, family members, or at least don't treat them differently than from a qualification standpoint as I would someone else who I didn't have a pre-existing relationship with, someone they knew. So just qualify everyone the same way. That's one lesson I learned. 2 is it actually opened up my eyes. So this is a good thing. It opened up my eyes to the value add business plan and how it can go wrong, but it also made me think, well, how could this have gone right? Because that is the foundation of what I do as an apartment investor. I add value. My company, we add value to apartment communities by renovating the interiors, what we did with this one house, and then increasing the rent, which I did not do with that one house, and staying on budget, which I did not do with the one house, but we do pretty darn well with our apartment communities. And so while the house was a flop, I ended up losing probably like $5,000, sold it, got it out of there, still in my first 3 homes, but sold that 4th one. While the house was a flop financially, it taught me some things I've then applied to much larger deals.
Yeah. And would you say that deal was the trigger for you transitioning into multifamily?
I would, well, that was the last deal prior, the last single family home deal. I think the trigger for multifamily was for me being apathetic towards my full-time job and then deciding to leave. I was youngest vice president of a New York City advertising agency and wasn't fulfilled, wasn't growing, wasn't contributing, wasn't mentally stimulated. And I decided I need to leave, do something else. So that was the main driving factor. And when I left, well, I don't have a W-2 job, so I couldn't get approved for a mortgage to buy any more homes. So ironically, it's when you don't have a job, you can get an apartment community by pulling investors' capital done. Get that deal done a lot easier than you can trying to find a lender to approve you for a $40,000 house when you don't have a W-2 job.
Yeah. And right now you own about 460, or you control about $460 million worth of real estate. Is there, of all those transactions you've done, is there one that really stands out as a keystone transaction, and one that's really propelled you forward with your business?
Well, it's tough not to say the first one, because when you start out of the gate pretty strong, then that helps build the momentum and helps helps with investor confidence. So the first one we bought for $14.1 million in Houston, Texas, and put in about $2 million for renovations. In 16 months, it appraised for $21.6 million, and we were able to return approximately 50% back to investors via a refinance. We still have that property today, and we would never project those types of returns. And in fact, there was a deal we bought, the second deal we bought, we've closed now on 20 deals. But the second deal we've bought, we actually modeled in. We're like, okay, the first deal, refinance, we returned approximately 50%. That's incredible. What would happen if we modeled that in, those refinance proceeds, into the second deal? Big mistake. Don't ever do that. That was not a very conservative move to set expectations with investors. It was an aggressive move, and we never have done that again, because what happened with the second deal, it too was in Houston. We do not have that deal any longer. We sold it, and I'll tell you the whole story. We bought it, and we bought it for $5.65 million, and we projected in our returns that we would do a significant refinance in year 2. Well, Mother Nature had something else in mind. There were 2 hurricanes within 24 months. The first 24 months that we owned the property, 2 hurricanes hit Houston. I forget the first one. The second one was Hurricane Harvey. I forget the name of the first one. Second one was Hurricane Harvey. Plus, within that 24-month period, we had a resident, and this is such a cliche thing, but it's true. We had a resident leave a candle on the floor, caught the building on fire, burned down the entire building. Fortunately, no one was injured, but the building's gone. So within 24 months, we had 2 hurricanes and 1 building burned down to the ground. And it was the refinance was not going to happen in 24 months. So, but we had projected that, and even though we were doing well with the property, we unnecessarily set the expectations way too high with investors on the refi. So, what ended up happening with the property, we ended up selling it for over $9 million, $9.1 million. Bought it for 5.65, sold it for 9.1. So we did very well, and investors were incredibly happy with the property. And we were able to sell it in year 3, and there was no refinance, but year 3 actually exceeded the projected returns that we had in place. So it went well. All's well that ends well. But for anyone who is doing apartment investing and has investors, the lesson there is to set expectations very conservatively by not modeling in the refi or supplemental loan proceeds into the return projections. Now, for all of our deals, we simply tell investors these projections do not factor in refi or supplemental loan proceeds. Should we do a refi or supplemental, then that would be above and beyond the projections that you see here.
Yeah, no, that's definitely a good way to do it. And you mentioned you sold that deal after 3 years. Just for somebody watching who might not be familiar, as a real estate syndicator, how would you as a general partner profit from a deal like that?
A couple ways. One is depends on the ownership split. In this case, it was a 70-30 deal with an 8% preferred return. So 70% goes to limited partners, 30% goes to general partners. After the limited partners have received an 8% preferred return each year of ownership plus all of their initial capital back, then we receive 30% of the profits from the deal. So that's one. That's a big one. The profits from the deal, 30% ownership, and then there might be a disposition fee of 1% of whatever the sales price is to prepare. There's a whole lot of work involved to prepare for a sale, and then over the course of the asset management fee, 2% tends to be industry standard. That's what we have too. 2% asset management fee, and then when you purchase the property, an acquisition fee, which varies between 2 to 5% of the purchase price.
Gotcha. And you started buying up multifamily properties in 2013. So you're well into your career in building that multifamily portfolio. How has this really changed your financial outlook and situation right now?
Night and day difference. Yeah, I mean,
Yeah.
I'm the top 1%, technically speaking.
Yeah.
So yeah, I mean it's yeah, I was making $150,000 at the peak of my advertising career. I started making $30,000, and then I climbed the corporate ladder, made 150. That's one acquisition fee, and we do a lot of deals a year.
Yeah. No, that's great. And just to close out, besides the money side, what's your time freedom like? Has that been a big shift too, from working, advertising to real estate?
It's very important. I was reading something yesterday. A gentleman said most people wouldn't trade wouldn't trade $100 million. Let me rephrase. No one would take $100 million but you'd have to be 100 years old, because you only have a year or two to enjoy the $100 million. No one would do that. So clearly, money isn't the most important thing. It's time, and the time that you have. Now, some people who are listening might say, well, yeah, but if I'm 85 and you give me 85 million, now we might be talking. But the point is that time is more important than money, because with time we can make money as long as we're efficient about things and intelligent about the action we take. So I work from home, and we have a corporate office in New York City where most of the team members are. But I live in Cincinnati with my wife. She's from Cincinnati, so we live here. And I work from my home office, and we got a young one. She's 2 months old, so I see her a little bit during the day, but at the bookends of the day. And my wife's here, and our dog's here, and we love each other, and we just hang out. And that's it. I mean, that's the stuff right there.
Yeah, no, for sure. So Joe, where can people find you if they're looking for some more information or they want to buy one of your books?
If you're looking to do what I'm doing, then a book called Best Ever Apartment Syndication Book on Amazon. I know any Canadian listeners out there, I have one review on the Canadian Amazon version, and then I have like 117 reviews on the American Amazon version. So you can go check out that book. And anyone listening to this who wants a free resources guide for apartment investing, whether you're looking to invest actively or passively, just email info@joefairless.com, and Samantha from our team will give you a resources guide with a bunch of resources to look at, to research markets, to books that I recommend, podcasts like yours, and other things that I recommend in order to further educate yourself on apartment investing.
That's great. And we'll put all the links right down below so people can just click on those. So Joe, just want to say thank you so much for sharing your real estate success with us today.
Enjoyed our conversation. Great catching up with you today.
Yeah, same to you. And to you, our viewers, I wish you well in your journey from purchase to profits. See you next time.